Assalamualaikum warahmatullahi wabarakatuh. Hi guys, my name is Janna. I'm 7th semester student who is currently taking a public financial accounting study program at Polytechnic Negeri Medan. In this video, I want to talk with you guys about one of the stage in an audit.
Okay.
Before we get into the material, maybe some of you are still wondering what an audit actually is. Basically, an audit is the process of collecting and evaluating evidence, both written and verbal. So, for every company that has financial statements, it's better to have them audited to give confidence to potential investors that the financial statements presented are in accordance with the applicable accounting standards. So, in conducting an audit, there are several stages. The first stage is pre-engagement, the second stage is risk assessment, the third stage is risk response, the fourth stage is reporting, and the fifth stage is general. Now, in this video, we're going to talk about the second stage, which is risk. Alright, let's go! What is the definition of risk assessment? Does anyone here know about it? Risk assessment is the process of identifying, analyzing, and mapping potential risks that an organization or company might face. The purpose of risk assessment is to identify potential risks and evaluate the likelihood and impact of those risks. In a risk assessment, there are several things that the auditor will perform. First one is initial materiality. Initial materiality is the level of threshold of misstatement determined by the auditor during the audit planning stage, which is used for calculation and consideration when setting the materiality level. The determination of materiality is basically based on the auditor professional judgment. A misstatement is considered material if it's expected to affect the economic decision of users based on the financial statement as a whole. Some of you might still not understand what this means, right? Okay, let me give you an example. In the planning stage, the auditor sets a planning materiality. For example, 50 million rupiah. If there a misstatement worth 500,000 rupiah, it may not need to be corrected if it's considered not material. The second is initial analytical procedures. Initial analytical procedures are the analysis of the relationship between financial and non-financial data carried out at the beginning of the audit. This helps the auditor understand the client business, assess the risk of material misstatements, and determine which areas need more attention during the audit. The main stage in initial analytical procedures include understanding business and financial relationship. The auditor studies the client business, including key business process, to understand a reasonable relationship between financial and non-financial data. Then, developing expectations. Based on that understanding, the auditor creates expectations about the patterns that should appear in the data. Then, comparing actual data with expectations. The auditor then compares the client actual data with these expectations. This comparison helps identify anomalies, such as unusual fluctuations, which may indicate the possibility of material misstatements. The third is understanding the entity and its environment. Understanding the entity and its environment is an early stage in risk assessment where the auditor studies the client business as a whole, including its industry, regulations, and operations, to identify and assess the risk of material misstatement in the financial statements. The goal is to get a comprehensive picture of external and internal factors that may affect the entity and potentially create significant risk. The auditor must also understand how the entity internal controls are designed and operated. This includes understanding the procedures, and policies implemented by management to control business risk and maintain the accuracy of the financial statements. The fourth is inherent risk. Inherent risk is the built-in risk that exists in a business activity or process before any control action are applied. So, inherent risk is not caused by internal control failure, but by the natural characteristic of transaction, estimates, or business conditions. For example, a company that sells frozen food store its products in a cold warehouse for 6 months. However, some products may expire before they are sold. Even if everything is properly controlled, the inherent risk still exists. The fifth is control risk. Control risk is the risk that a company's internal control system is unable to prevent or detect material misstatement in the financial statements. Assessing control risk helps the auditor determine how much they can rely on the company internal controls. If the internal controls are strong and effective, the auditor can reduce substantive testing. However, if the controls are weak, the auditor needs to perform more detailed audit procedures. The auditor must understand the internal control system applied by the company. These controls may include segregation of duties between employees, authorization of transactions by authorized personnel, periodic reconciliations, and restricted access to asset and financial data. Several factors can increase control risk, so the auditor needs to evaluate whether the existing controls are able to reduce the risk of errors or fraud that may occur. Control testing procedures can be carried out in several ways, such as interviewing relevant employees, examining evidence of transaction authorization, observing work process, and retesting certain transactions. Based on these tests, the auditor will determine whether the level of control risk is high, medium, or low. If the tests show that internal control are not effective, then control risk is considered high. In this situation, the auditor must expand the scope of the examination and increase the amount and accuracy of substantive procedures. On the other hand, if the controls are running effectively, the control risk is considered low and the auditor can reduce substantive testing in that area. Assessing control risk is important because it helps the auditor determine the strategy and level of assurance needed to conclude whether the company financial statements are fairly presented. The sixth is risk of material misstatement. The risk of material misstatement refers to the risk that the financial statements are materially misstated and do not present a true and fair view. This risk is assessed at two levels. The first level is the financial statement level and the assertion level. A misstatement means that the information that should be correctly presented in the financial statements is not actually what's written there. The risk of material misstatement affects other risks as well, such as audit risk, control risk, inherent risk, and others. The last one is communication with TCWG and SPI. Communication with TCWG or those charged with governance and SPI or Satuan Pengawas Internal is an important part of the audit. This communication involves sharing key information such as the audit scope, any significant findings, and other issues related to the audit. The purpose of communication with TCWG and internal control are to make sure everyone understands. The auditor and TCWG should both clearly understand the audit scope, timing, and process. And then, to improve audit quality. Good two-way communication helps the auditor clarify findings and receive feedback from TCWG, which improve the audit results. Then, to meet users' expectations. This communication helps financial statement users like regulators and investors know that the auditor has talked with the responsible parties as required. Then, to help decision making. The auditors share findings, including any significant weakness in internal control, so TCWG can take the right corrective actions. Audit matters that should be communicated include the auditor responsibilities in the financial statement audit, then the plan, scope, and timing of the audit, and then significant audit findings, and the last is the auditor independence. Communication can be done verbally or in writing. If it is communicated verbally, the auditor must document it. If it is communicated in writing, the auditor should keep a copy of it. So yeah, that's all about page assessment. Did you guys get it? I hope you did. I'm sorry if there were any mistake when I explained the material, and I'm still learning. Hopefully this video helped you guys. Thanks for watching and see you next video. Assalamualaikum warahmatullahi wabarakatuh.